And now, ladies and gentlemen, please welcome the first Vice President and National Director, National Retail Group, Marcus and Millichap, Bill Rose.
I don't know about you, but I feel fine. You all feel fine? All right, so several market observers think that it's the end of the retail world, and we have several market participants here today to tell you that's just a bunch of hooey. I'd like to thank all of you for coming tonight. Our firm, as you know, we've been in the business for 47 years. We've been producing deals for each and every one of you in the room. In the retail space, we have over 430 agents. Last year, we did 3,600 deals in excess of $12 billion. And a big thank you to each of you, because now 6 years in a row, we are the choice for many retailers, developers, et cetera, in our business to transact on a daily basis. It gives me great pleasure tonight to bring on our president and CEO, Hessam Nadji. Hessam has been in the business for 30 years. He is the trusted voice for the industry in many trade publications, CNN, Fox, et cetera. And it's sort of awesome because back in 1986, Hessam worked on TGI Fridays and Pier 1 imports. So great information tonight. Please welcome Hessam Nadji. Hessam?
Thank you, Bill. Good evening, everybody. Thank you for joining us. It's a pleasure to host you again on behalf of all of our agents and our management throughout the company. The reason we do this is our clients. And our goal, as it's been for 47 years, is to provide the most relevant and timely information that we possibly can to help you navigate the market. So if I were to guess in terms of what may be on your minds right now or throughout the last couple of days, I would venture to guess that this may be on your minds. Change. A lot of change is indeed happening in our business all around us, and maybe sprinkling just a little bit of uncertainty, just to add a little bit of flavor in the environment that we're in, and that would basically get us to where we are today. So I want to remind all of us that change and uncertainty are nothing new. We've been here many times before. In fact, if you look at where we've come from in the midst of the worst point of the Great Recession, the worst since the Great Depression, the U.S. consumer was telling all of us something very important. If you look at what the sentiment was back then, the consumer was never to come back out of the caves that they were supposed to go and hide in. Well, look at this. Look at this trend. We have grown retail sales by 28% above the 2008 peak. If you adjust for inflation, it's up 12%. At a time when the spending of the era was unsustainable, was fed by very temporary factors like over-leveraging, like using our homes as ATMs, and things that have not been present in this cycle. We have not over-leveraged, and we have not stretched the consumer. In fact, we have added 16.3 million net jobs since the bottom of the recession. We lost 8.7, incredibly high, very ugly, but we've added 16.3 million jobs. So the point of this is that not only have we done this looking backwards, we continue to add 2 to 2.5 million jobs a year. And it's been a very slow recovery. The benefit of its slowness, of its gradual trend, is that it's sustainable. And there's no signs of a recession around the corner. And as far as the economy goes, it's steady as she goes. Housing, finally, after the crisis, it's recovered to the point where it's contributing to the economy. Just in the last 18 months is when housing really came out as a driving force, especially for retail. If you look at the price trend on the left, every dollar of net worth generated because of the values of homes generates 5 cents of retail spending within the following 12 months. If you look at the sales trend, also recovered very nicely. For every home sale, we see generation of some $5,200 of retail sales. So the good news is that the pie is growing. The bad news is that the evolution, the trend of evolution that happens all the time seems to accelerate. every 20 or 30 years. In fact, I look back to this very event as we held in 2000, the year 2000, and our theme was shift happens. And indeed, shift happened. And it's happening as we speak. So look at this X, if you will, on the trend line of the share of department store sales as a percent of total retail declining from around 12% to around 4%, while electronic sales have done the exact opposite, almost in proportion. So there's been massive disruption of an industry. In fact, if you look at the notable displacement that we've seen, there are plenty of examples that everyone's aware of, and this has caused a lot of pain. This has caused empty stores, this has caused financial chaos, and it has not been a fun experience for a lot of investors and shopping center owners, and it's to be taken very seriously. We have experienced it, for sure. So if you look at e-commerce, or if you will, online shopping, it's the fastest growing segment of retail without a doubt. But if you step back and ask, where does this all fit in? Look at how it basically relates to total sales in the United States. Even though it is a growing segment, even though it's here to stay, even though it's grown so much over the years, it is still just a piece of the puzzle in a broader retail picture. We really believe that, and it's really important to think about that in the context of your investment strategies. So it's basically far from e-commerce alone that we evaluate the retail picture. Now, looking at this, you also see at the exact same time where those, if you will, victims of change that I just summarized have suffered, you have numerous brands that are thriving for a variety of reasons. And the common denominator seems to be value, being nimble and fast, and being extremely market and consumer aligned. Look at every one of these brands. Home Depot, the housing market. Think about what they've done to capitalize on the fact that people weren't buying homes, but they were renovating homes. Think about what's happened with TJ Maxx and Marshalls and the way that they've competed in this environment by keeping their inventory fresh. Think about Zara, who's a leading edge retailer in fashion design at incredible speed globally. So every one of these successful names has found a way to basically defy the trend. So it's not just the economy stupid, it's the consumer stupid. And we need to really think about what the consumer is telling us in every step of the way, in every aspect of it. In this environment, if in fact the victims that I just talked about have suffered so much, why is it that we're able to see an Amazon or an Apple or Microsoft opening brick and mortar stores? Why is that? Why is it that if you look at the upper right corner, the 8 out of the top 10 online retailers are actually traditional retailers? Why is that? Because they've basically evolved. And from a brick and mortar perspective, it's what's in the store. And it's basically what is in the store in the context of the experience that the consumer is going to have by being there. It's the draw. That is still working, even as we speak. So the highest tech of the tech firms are using traditional brick and mortar retail as part of their strategy. There's a reason behind that. So if you were to boil it all down, the real categories of retailers for your evaluation planning of any rent roll that you look at are either cheetahs, because they're moving so fast, or chameleons that are able to adapt to everything that we've talked about so far around them, or they're the slow-moving and highly vulnerable retailer. Which category does your rent roll fit in today, and how can you recompose it for tomorrow and through a value-add process? So here's our forecast. Massive retail investment opportunity ahead with a chance of disaster. That's basically, I think that's a pretty fair assessment. And we do believe this is the time to sell and the time to buy. Wait a minute. There's no bias. That statement, by the way, is true. I'll prove it later. So let's talk about why. The United States of America is the only developed economy that has an unbelievable demographic position. Japan is declining in population. Russia is declining in population. Western Europe is declining in population. Take a look at this. You hear all about the millennials. They're very important. For those millennials that are in the room, the world does revolve around you. We all get it. We get it. It's true. Let me just confess. So there is that wave. There is the millennial wave. We now have 6 million more millennials today than we did 10 years ago, and they're basically stabilizing. In the next 10 years, that number is going to grow by 600,000. So it's basically a stable population base. So you ask yourself, with all the noise around millennials, where are they all going? Well, they're turning 35. And so in the next 10 years, the 20 to 34-year-olds are actually going to show up in the 35 to 54-year-olds, which is even better because hopefully by that time they'll move out of the basement and can get a job. Maybe. I don't know. Let's not get too excited because I've seen some of the older millennials. It doesn't look good. We're going to add 4.2 million people in that age group, in the middle age group. And of course, the eldest are getting older. 55-year and above category is growing by 17 million people. But notice the 3 waves. There are 3 waves moving through the system at the same time for the next 3 decades. This is unprecedented. This is highly unusual. It is up to all of us to figure out a way how to play in this pool and capture the opportunity that it creates because it's plentiful. What do consumers want? The consumers, whether they're millennials or boomers, Gen Xers or whatever, they want experiences. If you combine travel, entertainment, and dining together, they would be the largest category of expenditures, 34% for younger people, 28% for the older people, more than any other category. Travel, entertainment, and dining. Travel, entertainment, and dining. That's what they want. If you take a look at how that manifests, anyone wonder why the single-tenant net lease business has been off the charts? It's because since 1992, when restaurant sales were just about 60% of grocery sales, have now converged to exceed grocery sales. We spend more money as a country on dining out than we do buying groceries. That is a profound statement. That is opportunity galore in terms of what it means for investors. And that trend is here to stay. If you take a look at the incredible wealth transfer that's ahead of us because of these 3 waves of demographics, today's older baby boomers are going to transfer some $30 trillion of wealth to the younger generation. God help us in terms of what they're going to do with that money. We've talked about that before, but hopefully some of it is going to end up in commercial real estate. I think it will. But that's an amazing financial wave on top of the demographic wave that's coming our way. Is retail going to capture its fair share? Well, we have some problems. Today, the headlines, I counted it in the last 30 days, the Wall Street Journal had no short of 6 major articles, 2 of them front page, about the death of retail. So it's getting a hugely negative rap in the media, in my opinion, overblown. Nevertheless, we have more retail per capita than any other of our comparable economies around the world. This is a problem. But if you take a look at what the marketplace does, this is why the United States is not Japan. This is why, if you think about our economy over the last 10 years, we have grown by $5 trillion. Total output, $5 trillion growth in the US. That's the total size of Japan's entire economy. That's how much we've grown. This country adjusts and adapts very quickly. Look at how the market has reacted to this by pulling back in new construction. This is the first time ever when expansion of retail has been this disciplined and this narrow 7 years into an economic expansion. It's never happened before. By now, we'd be catching up to long-term trends, and we're not even close, and won't be for a while. Part of it is the discipline on construction lending. Part of it is the lessons learned from the Great Recession. But the point being that the industry is already adjusting. Take a look at this. Retailers themselves, even though there is a lot of pain in retail and lots of tenants suffering, especially the weaker local ones, retail profits are at an all-time high. That's the green line. Why? Because retailers learned very quickly after 2009, 2010 to adjust their footprint, to adjust their systems, and get their inventory to sell ratio way down. And it stayed down. This reflects efficiency. Retailers are adjusting really, really quickly to the world around them. They're not just sitting still. This is a hugely positive force. Now, store closures, you can debate if the numbers are right or wrong. My point about sharing store closure information with you is that going back, way back, I went way back to the 90s, there's always store closures in this business. We've always had store closures in this business. Very high churn, very high velocity. That's the entrepreneurial nature of retail. It's been that way forever. And if anything, it's been trending down. Now, in 07, it could reverse. In 08, it could reverse. There's a lot of pressure. Department stores, electronic stores, and older malls clearly are experiencing store closures. But the long-term trend is down, and it's nothing new to retail. If you take a look at what's happened then with investment sales, in light of all this, you can see about a 15% decline so far this year in investment activity, both in the number of transactions and in the dollar volume of trades for retail. There is some uncertainty for many investors regarding tax reform. I'm not really talking too much about that tonight because it would be pure speculation as to what's going to happen or not happen. We really don't know. But in the meantime, the sideline players that are looking for, let's call it unfair or overly exaggerated price reductions are staying very frustrated because of the fact that fundamentals are in good shape, we have not over-leveraged, and in today's marketplace, this slowdown is actually a huge opportunity. Fewer properties on the market in terms of inventory, a little bit less competition, but I can assure you, there is so much capital for well-priced assets in this marketplace. The slowdown is in the disconnect in the bid-ask spread, which right now has something to do with the uncertainties that we talked about. Now, going back to what these demographic waves mean for our business and your investment strategy, again, I show you the number of 55-year-plus aging baby boomers and their need for yield investments that are low management intensive. The amount of capital coming out of apartment exchanges going into single-tenant net lease, the amount of capital that's going into both multi-tenant shopping centers and single-tenant net lease explains the power of this, if you will, quest for yield. Also reflecting the 34% increase on top of the peak from 07 in the number of single-tenant net lease trades. The demographic, the consumer is behind this trend because the capital needs the yield. In fact, if you were to question whether the market is in the position of major price adjustments, the spread between cap rates and interest rates, even though you could argue that as interest rates go up, which we anticipate will go up moderately, is going to be challenged for sure. Pricing is challenged to some extent, and some adjustment makes sense on a broad basis and on a project-by-project basis. But the point is that the underlying strength shown here in terms of the spread is still there, is still in the marketplace. So let's talk about interest rates for a moment, because if you are concerned that interest rates are really going to break that formula from the previous slide, then you wouldn't transact and you would be out of this marketplace. We had a guest last year, his name was Ben Bernanke, and one of my questions to him was his forecast for interest rates. And he basically said, there really is no reason for interest rates to spike or to go up. Now, we saw a spike in the fourth quarter because of the unexpected outcome of the election and the growth orientation of the Trump administration, which is all long-term positive. Short-term, it spiked interest rates and kind of threw the market for a little bit of a loop. Interestingly enough, if you go back to the 70-year period before 1970, from 1900 to 1970, guess what the average yield was on the 10-year Treasury? 3.2%. We went through a high inflation, multi-decade period of 1970 to 1990. It ran its course for a variety of reasons. We don't have time to get into that tonight, none of which are present today. Oil crisis, energy spikes, and now we've basically normalized into that same range of interest rate. Are the interest rates going to go up? Yes. Are they going to spike to the point of disrupting the marketplace? They really shouldn't. Where should you invest? Again, lack of time, I just have to tease you with the point that if you look at the major metros in the United States, the left are major markets that have the best growth prospects over the next 10 years. Look at Dallas is expected to grow by 1.5 million people, or almost 20, or a little over 20%, versus a national average of 7.2% population growth. Do you think you might want to be in Dallas? I think you do. But does Dallas tend to overbuild? I don't know. I won't answer that question. The answer is yes. Houston, population growth, second best in this ranking. Is that an opportunity today? I believe it is, because of what's happened to energy prices, and so on. The other thing that we did for you was to do the same for mid-sized markets that are not the major metros. So Orlando, Charlotte, Austin, Vegas. Look at these growth numbers. They're off the charts. These markets have to be part of your long-term plan. So, Retail Trends 2020. When we're back here 3 years from now, I think we'll be talking more about driverless cars. I think we'll be talking about your personal robot that will also act in the capacity of your personal shopper using the driverless car. But with artificial intelligence going the way it is, I think they can also spend some quality time with your kid. If Elon Musk had anything to do with it, that would be happening. But I don't think so, not so fast. If you remember 10 years ago, 15 years ago, there was such a buzz about the death of office space. And IBM was leading the charge regarding telecommuting and working remotely, right? This is from Friday's Wall Street Journal. I saw it on a plane flying back from New York. IBM says no to homework. They want to bring workers back into the office space for the collaboration and the touch points. ICSC attendance. Why are you all here tonight? All of this is available online. Everyone you met with in the last 2 days, you could meet with through video conferencing. We're here tonight because nothing replaces the touch point and the experience at the end of the day. E-commerce is an enabler of what the consumer wants, and these trends and demographics in particular that I just talked about are the enabler of fantastic retail returns over the next 10 years. With that, I'd like to invite our panel to please join us up on stage, and I'm going to turn the program over to Bill Rose. Thank you very much.
Thank you. It's always important to keep that bigger picture perspective. Many of us in our markets, we're so micro-focused we don't see it. Ladies and gentlemen, please welcome to join now our market participants who are there live every day. Stuart Tanz. Stuart Tanz is the president and CEO of ROIC. It's a publicly traded REIT. If you'd like to buy his stock, it's available. Stu's seen many cycles. He began his career with a great little shopping center in 1986. John McNellis. John has been a developer for a very long time. He's produced a book for us that you're very welcome to have. He can talk to you about it. But in 1976, John bought a duplex and redeveloped it for how much?
$24,000.
$24,000. So pretty cool stuff. Tom McGinnis. Welcome, Tom McGinnis. He's the president and CEO of InvenTrust. Tom, way back, 4 years ago maybe, his first deal, a 6-flat in Chicago. So welcome, Tom. And of course, Adam Ifshin. He bought a center in Orange, correct?
Orange, Connecticut.
1982, and today he is the president and CEO of DLC Management, has numerous shopping centers all over the East Coast. With that, we've seen a great snapshot, gentlemen, of where the market is, what you're experiencing, and I always hate the silly question of where are we in the cycle. What I'd rather ask each of you is you've experienced many cycles. What do you look for? Tom, what do you look for in the headwinds out there to indicate something's changing? And then, what do you do about it?
Well, it's to the degree that you get sales, it's about sales. It's about productivity. It's about occupancy costs for the retailers to make sure that they're doing well. But then you break it down into that sub-market to make sure that the demographics haven't changed in that area and it matches the retailers that you have, talking about it from a site-by-site basis. And then unemployment, interest rate, all of the macroeconomics, look at all those at the same time.
And so back in 2007, I vividly remember a cocktail party. You were all probably there. Everybody's high and has good times, things are great, but no one saw a change in tide except for, I think, Stu Tanz, who you sold Pan Pacific.
I did.
How did you know?
Well, for me and for our team, there was really 3 things that told us to sell the company. One was sales and really the occupancy costs related to sales, that number was heading into the double-digit side. The second thing were buyers. The buyers were coming into the market, and the behavior of buyers was becoming very stupid. So they were coming certainly to the West Coast. We're on the West Coast, and our focus is grocery drug anchored assets. But they were buying, making offers on shopping centers without doing due diligence. And when someone is buying a shopping center and going hard on their money before they do due diligence, I certainly can't compete in that fashion, and I won't from a risk perspective.
All right, so when people are buying your centers and going hard, maybe an alarm bell. Adam, you're on the East Coast. It's had a lot of different waves over the cycle that you've seen. Today, is there any indicator for you that, I don't know, we could be at the top?
I mean, clearly, I think that the entire market right now is in a price discovery mode. I think to the presentation earlier, there's no trigger point, there's no obvious trigger point out there to cause the type of disruption that we saw in '07. But clearly the market is rethinking what's an acceptable return, both levered and unlevered, for certain types of assets. If you think about the risk-reward continuum, right? At the core end, it certainly still feels very anchored at historical tight pricing, low cap rates. But we're seeing, as you move out the risk-reward curve, right, that there is a lot of capital available, but a lot of it is pretty particular about the types of returns it wants to make for the risk it's prepared to take or not take. So I think where you're seeing the price discovery is something that's no longer that pure core bucket. Most of the markets we're in are growing, but slowly. But we're not in these markets that are growing in the Southwest and in California at the rate that some of them are. So it's much more a wait-and-see attitude right now in the East.
Wait and see. And John, as a developer, you got a scary job because you're going to start developing in one part of the cycle, and you might not deliver at the right time. How do you really pull the trigger on a new project? Or when do you know?
Good question. But first, I'd like to go out on a limb and say, I don't care who knows it. I think Hessam did a great job with that. Let's give him a round of applause.
Very good. Thank you.
I'm not as smart as these guys. So I think of myself as a farmer. The cycle is so long that, we have to plant through rain, through drought, and we just kind of keep plugging away at it. I cannot time the market. I mean, Stu's play in 2007 and a couple other guys, that was brilliant to time it. We, of course, should have sold everything too and then bought it all back, but we didn't. So anyway.
All right, well, that's anticipating then when we're at the top. When do you have the guts to jump in and buy again? So I'm reflecting back now on '09. Everyone was cold and frigid and scared. And I hope to not make you look so cool, but you were then. You were starting to buy assets then. And today, how many do you have on the board?
We have about 85 shopping centers today. So we've been the most active buyer on the West Coast since '09. But we were very aggressive in '09, '10, and '11. Number one, we had cash. And number two, people were so scared. Outside of the capital markets being closed down and the financing markets closed down, it was really about getting into the market and finding opportunities that we had never seen before on the West Coast. I think the one thing that a credit crisis brings, or disruption, as you say, is the opportunity. And that opportunity in '09 and '10 and '11 will come again. But the reality is that back then, with the capital markets shut, with financing shut, we were able to buy assets that had never traded in the marketplace because of the balance sheets of these sellers that got into trouble.
Great. And so for the audience, perhaps, Hessam, you just a good snapshot of the retail sector. Are there any triggers out there that you monitor, perhaps in the industry, to suggest that maybe things are going to shift, that we all should be paying attention to?
Well, it's interesting. If you look at all the different property types, apartment prices today are 42% above the '07 peak, 42%. Multi-tenant retail is about 11% above the '07 peak, with much better fundamentals in that you don't have loans that are about to become landmines and just blow up everywhere. If you look at single-tenant net lease, prices are up about 15, 16% above the prior peak. Again, with good fundamentals, because we haven't overbuilt the space. So in so many ways, office, by the way, is barely break even. It's like maybe a couple points above the prior peak, meaning that retail is still undervalued relative to, let's say, apartments. That's why we have so much exchange dollars coming out of apartments going into retail, not just single tenant net lease, but other types of retail. I think what's quite remarkable about this cycle is, are we going to see an '09 repeat, or are we going to see another normal recession in the next 2 to 4 years? And we will. It's a cyclical economy. It's a cyclical business. We'll have another recession, for sure. But is it going to be a 60, 70% drop in velocity and 40%, 20 to 40% drop in values? At this moment right here, I don't see the evidence that that's what's next. I think it'll be more of a normal recession, if there is such thing as a normal recession.
So I guess, Bill, to that point, I mean, one thing that was a term that was used quite openly in 2009 was the Great Recession. And people don't use it anymore. If it was 2000, 2001, that recession, the fundamentals today going into the last 2 or 3 years are so much different than they were in 2005, 6, and leading up to 2007. I mean, no over leverage, banks weren't lending, wherever. There was no overbuilding. The fundamentals today are just so much different. So that when you talk about a normal recession, that feels, if there is such a
like
thing,
a normal
right?
recession, right?
That feels like that does make sense.
And there's really been, people have been selling because they want to sell. There hasn't been pressure to sell. And that goes to Tom's point about the lack of leverage in the system. We're operating across the retail spectrum with so much less leverage than we had when Stewart made the transaction, and the buyer in that transaction in '07, the amount of leverage they use now would be unfathomable today. Mm-hmm. So you're seeing much more discipline across. The other thing too is that in only a very few markets are rents unsustainable for retailers. Retailers have employed better discipline. They're opening, on average, fewer stores. So as a result, we haven't seen rents get, to a place where retailers can't afford to pay those rents. And I think that's a key component of this, because, we start thinking about sales, but it's the ratio, not just nominal dollar sales. And clearly, rents haven't grown the way sales have, and that's allowed that ratio to be healthier now than it was in '07, significantly.
Adam, you brought up leverage, and Hessam spoke earlier about interest rates. We know there's going to be an increase, and a lot of people are price adjusting. What advice could you give to our folks here in the audience tonight about if you were to acquire a deal, in the next couple of months maybe, how would you finance that deal, just a straight-up deal? You choose a lot of different options. What would you recommend they be thinking about?
I mean, look, clearly, Bill, it depends on what the deal is and the specifics of that deal, right? There are certain types of assets for which the CMBS market remains the most efficient source of funding. But clearly, we've seen in this cycle most retail trades be financed away from that, right? The insurance company hasn't continued to expand, I think, more than most people thought it would in terms of providing liquidity to retail. And clearly, on-book bank lending has proven itself to be the best option, assuming that you can develop those relationships. You don't need leverage above where they're prepared to go, because, to Hassan's point earlier, change is the constant in this business, and having a lender who can work with you and roll with you and have flexibility on good days and bad days, I think is the most important part.
Right.
But you have to be prepared to live at 60, 65%, and if you need 75 or 80%, then you're going to be in the structured finance CMBS world, and you have to decide if you're prepared to deal with the constraints that imposes on your deal structure.
Right. So Adam has a penchant for buying value-add assets. Some people don't see how you can reinvent that asset. Perhaps bridge financing works better for you on some of those deals.
Clearly right now, it's been hard to find high quality, high value opportunities in the value-add space. We have managed to deploy about $830 million of capital in the last 4 years. We've had to do a mix of primary, secondary, and tertiary markets to do it. We had to take risks that we were comfortable with that not necessarily everybody else would. One of the key competitive advantages we have is our relationships with our lenders, because in many instances, we were able to go and finance transactions at a competitive level that other people couldn't or didn't think was available in the market. And our focus, notwithstanding our value creation ethos at DLC, has been, particularly in the second half of this cycle, has been on how much of that total return that we want to make can we get from the cash flow hold period of the asset, and how much can we minimize the need for sort of the magic pop at the end in a historically tight cap rate to get to the gain you want to make. So, I mean, a lot of people in the room know we did the largest open air trade on the East Coast last year, $390 million. And in that deal, we programmed that 73% of our total return would come from cash flow during the hold period, and then another 11% of it was effectively amortization under the loans.
Was that cash flow during the first 10 years?
5.
5 years. You'd get 73% back.
Of the total return.
Of the total
we projected to make, not necessarily 73%.
The problem, folks, is if you're buying at a 6 cap and hoping to keep your debt at 3%, that's great, and if you can tie it up for 10 years, but sooner or later, and I've been wrong on this for 15 years, but sooner or later, interest rates go back up, and there's a piper to pay. But if you can get back 73% in 5 years, I can't argue with that.
John, one comment you made to me about a month ago when you and I were talking that does concern me and was a concerning point in prepping for tonight is the lack of pricing power as an owner right now. Even with construction having pulled back, even with all the positive things that I shared, you mentioned to me that your number one concern is lack of pricing power because the strength in the tenants just aren't there.
Yeah,
Talk
in fact,
about that.
I would love a show of hands. So I develop in Northern California pretty much within a 2-hour drive of San Francisco. So arguably one of the best areas in the country. And I've been doing this for 35 years. And I am happy, folks, today to sign leases at more or less the same rate I signed 20 years ago. Same numbers, not inflation adjusted. Stu has a different sense of it, but it is tough. Anybody here having a lot of success in pushing rents on tenant renewals? I'd love to see a show of hands. Other than Stu, who I don't believe.
Well, guess what? You have to believe it because I report it publicly, so.
Okay, all right. This guy's a magician. Anybody else? Okay, everybody else is on my side.
I don't think you have a lot of takers, John.
What's that?
I don't think you have a lot of takers.
Well, let's take that idea. So the art of pushing this and really creating rent growth is not just going back to that retailer and saying, hey, how about a rent bump? Let's talk about a condition we're all hearing right now. You have a department store, or I should say a junior box in your center. What are you going to do? You get the call. Maybe it was CompUSA or Best Buy or one of those guys back in the day. They called and said, Stu, we're gone. What did you do?
Depending on the circumstances, we said, great, leave, okay, is basically what we said.
Right.
I mean, look, every market is very different in terms of the metrics you're going to get as it relates to in terms of leasing and in terms of management. But I think we got to go back to what you've just heard, and that is the debt markets today and the impact that the debt markets are currently seeing from all the alternative news or fake news that we're seeing out there today. In the triple net space, danger is, in my view, is coming because a lot of the private equity funds that took a lot of these tenants private levered up their balance sheets, but more importantly, the way they got liquidity was to rewrite these leases at much higher rents. Look out, because that is the tipping sign for trouble.
All right, so how do I analyze that? Let's say I'm buying that property today.
Well, the way you have to analyze that is the underlying credit of the tenant. But what you could be seeing on the horizon here in that particular part of retail is the fact that these leases have been rewritten at much higher rents, and that when these tenants go into bankruptcy, it's going to take a longer time to lease and a lot of roll down in terms of those rents. That's the triple net space. On the retail side that we play in, you've got to look at the different silos. There's different silos of retail. The grocery anchored side today has been the island of safety. Everything else is now being questioned in terms of the viability. And as we heard early on in the slide presentation, trends come and go, retailers come and go. So no one's disappearing. But the bottom line is what you could have done to answer your question 8 years ago was take that box, cut it up, and eventually there's enough demand to fill that box. Today, that demand is virtually gone. So the concept of a box today is going to look a lot different than what we've seen in the past. In fact, a lot of developers and owners today who are faced with empty boxes are basically redesigning these boxes where all you now have is the front, 100 feet or 80 feet versus 160 or 180. And they're redesigning the box where you're going to end up potentially with 20 or 30,000 square feet of vacant space in the back. That's going to be the way of leasing these boxes going forward because of the internet and other forces out there. The prototypes for most of these tenants are shrinking because their omni-channel side of their business is really putting a lot more emphasis on how their sales are done and how their profits are made. So it's a whole different world in both aspects of retail right now.
Look, there's
Tom, that's a West Coast perspective.
No, but
you're all
I
over
want
your
to add to
portfolio.
what Stuart said. We were talking before we came up here, and that is that today the small shop space really kind of saves the day in many ways because that's where you are getting rent increases or that's where you're raising some of your occupancy costs. But going back to the question of rent increases for the junior anchors, for the bigger boxes, if it was a lease that was entered into in 2006 and 2007, you're probably not getting a rent increase today. But if it was a lease that was entered into maybe in the early 2000s or in 2009 and 10, you're probably now getting a rent increase. So I think a lot of it has to do with the timing of it. But it is interesting, Stuart, you talk about the vacant space behind it. That might actually be okay if you have the retailers that are going to use those for distribution facilities going forward, right? For the internet sales, we were meeting with many of the retailers today. They want to be able to compete with Amazon. Maybe they're not going to have drones and they're not going to have boxes dropping down on someone's living room, but they want to be able to use those as distribution hubs so that they can get them the next day. Excuse me, or even some of the electronic retailers where they have repairmen, they have other people that maybe they're dropping off some of these things too. They're trying to make themselves be more efficient.
Guys, I think to Hessam's point, to everybody's point, the internet is clearly a big problem for retail. It's not the problem that the Wall Street Journal, and you're right, every single day. It's like California's rain season this last year. Every single day, bad news. It's not that bad, but there's no question when Walmart is one of the best retailers out there, they figured it out. Now, and Walmart is becoming a distribution center. Walmart then says, okay, folks, you order it online, you come pick it up. Everybody's store is going to shrink, absolutely across the board. Your one slide I had some question with, I saw that we had 50 square feet everywhere else of square footage for every man, woman, and child, versus 2 or 3 in the UK and Europe. We have too much retail space across the board. Personally, I'm going to sell all my shopping centers and buy ROIC stock.
Well, John, we have brokers here tonight that can help you with that.
Yes.
So let's go I want to move to Adam because this notion of, okay, we got this box space converting, and now what do I do with it? And you're in the East Coast. There's a lot of density there.
This is a micro business. This isn't a macro business. So we have a situation where Kmart, we bought it as part of a larger center 2.5 years ago, $2.59 semi-gross rent. We make more money than they were paying us by leasing 2 pads in front of their building before I ever lease the building because I get rid of the restriction, right? In a 6.5 to 1 parking field, which is completely overparked. It all comes down to the underwriting. It all comes down to understanding what, to your point, the tenants who are in the market can pay. We're making 5 deals right now with a national retailer in the box space, 25,000 square foot average, right? But if you program them to do $14 and that you can put them in the space for $30 a foot and work, you're never going to make a deal with that tenant, right? But if we program $10 or $11 with $50 in work, right? Now we got to pay the right price for the asset, right? But there's demand out there. What there isn't, because the tenants have choices and the tenants are disciplined, right? The same way the leverage market has been more disciplined this cycle, the tenants have been more disciplined this cycle. So as a result, this is not a time no offense, this is not really a time for newcomers to come into this game at this point in time in the cycle. You need to know what you're doing. You need to know what it really costs to put these types of tenants in possession, and you have to be able to buy your deal at a return level that you're prepared to make based on what they're prepared to pay, not what you're prepared to put in a pro forma.
Yeah, I want to underscore what Adam said. We talked about this last week. I'll give you some exact numbers. We took a 100,000 square foot Kmart in Northern California, chopped it up into four tenants, 2 25s, a couple 30s. All in cost, putting aside the purchase, $8 million. So that's $80 a foot just to do the exterior remodel, split the space. And we averaged about little over $10 triple net. The Kmart had been paying 15 triple net. So I see this all the time, and again, to echo something you said, there aren't brilliant opportunities in the value add business. I think I like this. It's a wonderful time to buy and sell. You just have to know which to sell and which to buy. Very tricky.
Right.
This is why you have the best retail brokerage firm to help you out.
Well, let's take that then to the demographic picture that we saw.
How's that?
So we saw demographically, and thank you for the plug. That was not paid for. Let's talk about the demographics that we've just heard. So we know we have this population that is mature. We know this population that's coming into the market. How do you guys as shopping center owners, developers, how do you re-engineer your center, A, to make it a lot more interesting to go to, instead of doing this and have the helicopter thing show up? How do you make it more interesting for me as a consumer, and how are you maybe programming space to deal with an aging population? Any of you?
Well, look, the first place to start is at the asset level itself. We typically will spend on most of the properties we buy between $100,000 to $300,000 right out of the box. Why? Because by adding a bit of landscaping, doing some repaint, putting some lipstick on the property, that creates a situation where that asset now, from a competitive perspective, makes it better than anyone else. So the first step is at the asset level. And then the second step is the re-merchandising side. That's critical. Looking at the current tenant base, looking at what works, what doesn't work in terms of demographics and the change in demographics, and then playing offense in terms of repositioning those spaces to put in tenants that are going to deliver a much higher sales approach in terms of the overall foot traffic that come in and out of the center.
Who's your favorite go-to tenant? When you've got that.
Well, every segment is a bit different, and today, depending on which segment you look at, you've got new entrants, some new entrants. You've got people that are expanding. You've got people that are very good at what they do that aren't expanding. So every segment of retail is going to be different in terms of how you merchandise.
Right.
When you look at the demographics, there are certain things that stand out, right? The big mover isn't what's happening so much with millennials, although it's very important. The big mover is what's happening in the next age group up, right? That's 17.4 million people we're talking about, right? So you have to start to think unconventionally with that excess space. We've now done in the last 18 months 3 deals with 3 different hospital systems, roughly 30,000 square feet apiece, taking over a former Office Depot, former supermarket, former sports or circuit, can't remember which. In each instance, their credit, in 2 of the 3, their credit's better than Walmart's. I have very little concern they have no debt today and are going to get bought out by private equity tomorrow. The spends are big. We've spent between $75 and $100 above sort of some base building work, but we're generating high teens to low 20s net rents from credit tenants. They are 3 hospitals, right? And this is peds, radiology, ENT, internal medicine, orthopedic, physical therapy. This is not, urgent care.
And this is for retail brokers and developers. Patients.
Yeah, no, but
that's viable. That's real.
highest and best use.
The first one we did, we had to get 5 waivers, all for 5 major national tenants. It took a year. And they all thought that they were going to have a parking problem, and they all came back to us and said, the uptick in traffic is really material, and now we understand it.
But it goes back to what Stuart said. I mean, knowing your assets and knowing what's around your asset. And really going back to the previous presentation, if you have a heavy millennial count in that zip code, you're going to populate it with one. If it is, in fact, maybe an older, it's the baby boomers, and you go with a hospital network. And it's interesting because a lot of these where it's full service, radiology and all the rest of them, you obviously can't go to a doctor and not wait an hour or two. And then if you're going to have an x-ray, et cetera, then you're going to the restaurant, you're killing time, you're doing all the rest of them. But I would say that the one single use that drives people in today, and we saw it in the presentation, is restaurants, right? Crosses grocery stores. You know, now Stuart is absolutely right. Groceries are the panacea. It really is a safe haven. But I think restaurants really drive people in even more than grocery stores do. Fit a new restaurant concept with the neighborhood, and you can't go wrong.
Will e-commerce ever crack the grocery code, or the restaurant code? Because in the past, they've tried, but it really hasn't worked.
Yeah, I think the answer is no. You've always had, from the very first grocery store in prehistoric times, they had home delivery. Home delivery has always been around. It's always been necessary. It's always been a loss leader. But the idea that people are going to have minimum wage folks go pick their groceries and deliver them, I don't see that as a real concern. Also, Safeway has had home delivery forever. Safeway charges $15 on home delivery, right? And that's about what it costs. Safeway doesn't make money at it. If you got all these guys Instacart and everybody else delivering for free, what they're doing is buying market share but losing money. Folks, there are only two companies that make any money in internet retail, and that's FedEx and UPS.
That's right.
Everybody else.
Talk to any one of the retailers, they'll tell you that.
That's right.
So, this is like the siege of Leningrad. You've got all these internet retailers who are banging away on us, but they're dying. Their troops are getting wiped out, and they're all rolling. I don't know why the hell they call it omni-channel, because there's only two channels. They could call it dual channel. There's bricks and there's clicks, right? And I just read in that same Wall Street Journal on the inside page where it says, on the page one, retail falling apart. On page two, it says, latest internet retailer to open bricks. What we are now known as, this is kind of funny, shopping centers are called offline distribution. So,
But the answer is yes. It is going to have an impact. And here's where it is going to have an impact. It is going to have an impact in the urban cities around this country. There's no question about it. I mean, let's look at London. Let's go around the world and look at the impact. London today, 16% of all the groceries are come off the internet. So you've got to study this as it relates to demographics and as it relates to urbanization. The reality is, you bet it's going to have an impact, and it's going to be a bit dramatic. So
what do you do about it?
Well,
It does impact grocery.
so here's one of the great parts about this that I think is really good for all of us, and that is that people have been saying the suburbs, right, and the issues related to the suburbs in retail. The reality is the suburbs is really going to have the least impact in terms of e-commerce. It really comes down to the urban. Millennials are all moving, they're all urbanizing.
Right.
If you look at what's happening around the world in terms of e-commerce, the real impact is in those cities. That's where you're seeing a huge impact. That's what's coming here. New York, Chicago, just go around the gateway cities. That's where you're going to see groceries have a pretty big
I
impact.
think the key is Amazon has spent since they introduced Prime, I don't remember exactly when it was, right? They're doing exactly what the airline industry did after deregulation. They are educating an entire generation of consumers to expect to buy something for less than its true cost delivered to their door. And the question is very simple. They're not making any money in apparel where return rates run in the low 30s. That's a business with, call it, a 40% gross margin. How are you going to do it in a business with a high single-digit, low double-digit gross margin and a low to mid-single-digit net margin?
yeah, this is where I'll disagree with Stuart on that. Once Wall Street says, okay, Amazon, no more free pass. Okay, Instacart, no more
Good
free
luck.
pass. You got to charge that $15 that it costs. I bet a lot of those people in the cities will say, because the average grocery ticket, I think it's like $25. If there's a $15 delivery charge, even if you buy $100 worth, a lot of people are going to say, well, hell, if I got to pay for it, I'll go get it. Amazon is not opening supermarkets left and right, and Amazon is not opening bookstores left and right because they're making any money at it. And Amazon's, what's it called? Amazon Fresh?
Prime.
Fresh?
Amazon.
No, the supermarket, I think it's called.
The Amazon.
Yeah, Fresh. Amazon Fresh.
So I'll put it to you folks in the audience. Which would you rather do? Go to Whole Foods or Safeway anytime you want and have 54 kinds of Oreos there? Or would you rather have a 2-hour window at a little Amazon Fresh where you've ordered your basket of groceries, you've got to go pick it up, and you can go inside and they've got one SKU, they've got 500 basic things, only one kind of Oreos, you got to show up at a certain time. You still have to go to the market. Right. I don't think, one thing I absolutely agree on, in a competition-constrained environment, a neighborhood supermarket center is the best way to go. There you are.
Here's one thing I wanted to throw.
I don't have an opinion on the subject.
Throw it open to the panel. Is we talked about millennials, and now they're starting to get up into their mid-30s. And what are they going to do from a home ownership perspective? And is there any correlation of, are they going to not only move out of mom and dad's basement, but God forbid they'll buy a house, they'll have kids, they'll start buying all the rest of those things? That just seems like that's going to be incredibly impactful for...
They're not buying homes. That's the
Well, they're
situation.
not today.
I
Will
have to tell you something. The world's got to stop bashing on millennials, okay?
You've never met my daughters.
I have 3 millennial children of my own. The world's got to stop bashing on millennials. We have a lot of young people who work for us. They keep us young and nimble and semi-interesting. But they're gonna. I don't see demographically a trend where American millennials are planning on having, one child the way Japan, France, Germany have, and that's what leads to falling population in the long run. I just don't see that. And I think over time, because of the nature of the economy, it's not like they have so much money that they are going to be able to afford to raise multiple children in urban settings. A few will, but let's face it, we have an education problem in this country, right? And that education problem is worse in urban areas than it is in suburban areas. And I don't think it's going to go back to the way it was of, the 50s and 60s. But I think for people to think that the suburbs are done is very, very short-sighted.
No, in the long history that all of you have been practicing and participating in this industry, you've seen so much change from back in 56 when the first enclosed mall opened to the very rollout of all of these different strip centers that we've seen to today, these great lifestyle experiences. What advice can you give the audience tonight on, from what you've experienced, from what you know today, quick snapshot of Hessam's 2020 of that robot coming to your center? What advice can you give the crowd? Stu, go ahead.
So what advice in terms of starting out in the business? What advice in
You
terms
decide. You know what? This is a great industry that we're in, and it is that opportunity to say, you know what? In the year 2020, I wish I would have done this.
Well, look, the best advice is to, be passionate about what you love doing. And as it relates to the business that we're in, it's that, that trees don't grow to the sky, that there is risk. And that risk is beginning to become much greater in scope as it relates to the retail business. And to be very careful in analyzing that risk as it relates to making money in this business.
Great, very good. John, how about you?
Actually, Hessam hit on it, and I'll stress it. Let's just assume we're all in retail. I don't think it really matters what you develop, but where you develop matters a ton. If you're going to start out, just for a starting out person, you need to pick an area, a city, a region that has really strong growth. That is my best advice. And if it's Dallas, I don't think it is, folks. Sorry, Texans. But if it's Dallas, that's great. George Marcus loves to say, the two key words of success in business, in real estate, are supply constraint. There is no supply constraint in Texas. So I would pick one coast or the other.
Tom.
I guess I agree. I think millennials get bashed, but and maybe it's warranted, maybe it isn't. But I think you look toward all of us up here with gray hair, and you assume that we have the answer. But realistically, I think you all are probably in a much better position to drive your own careers going forward and kind of build and mold what each one of the organizations should look like, and really what shopping centers of the future should look like. You're in a much better position than we are to really drive that going forward.
That's great.
If it's your own business, the one job you can never give to anybody else is you have to be your own chief risk officer, right? And you have to think about, how am I going to mitigate risk and what risk I'm prepared to take in any given situation.
That's super good. Hessam, how about you? You're monitoring all this.
Well, this is phenomenal dialogue. I'm just sitting here listening, and the one thing that keeps coming up for me is, how do you turn the current negative dynamic and the headlines and so on into an opportunity? And the major players that I interact with, I was on a panel with the CEO of Westfield, across the board, all the major players are really getting out of B's and C's, whether it's product or markets, and they're hunkering down on their A's, building fortress investments in their best locations and their best assets. Makes a lot of sense. What that means to a lot of private investors, vast majority of people that are sitting here tonight with us, is you take those B's and C's and you think out of the box, and you think about reuse, and you think about how the real estate can be reconditioned, recycled, for whatever is in the path of growth in that particular trade area. That, to me, is the magic. Where 2020, you can look back and say, yeah, we bought an old, tired mall, but look at what we did with it based on what's happening in that trade area, whether it's entertainment, whether it's health-related, look at the categories of retailers that are thriving right now. The vast majority are either tied to a big trend like housing, Home Depot, or restaurants, the preference to eat out, or personal health, education, and medical services, which has to do with the aging of the population. Right. It's the recycling of real estate. So don't think retail, think real estate. And that's where I think the magic is.
There it is. It's always in the real estate. It is not the end of the world as we know it. Rather, it is a new beginning for all of us in this industry. And I want to thank each of you for providing guidance and insight. Continue to make it happen. Thank you.